Let me tell you something right now, and I need you to really pay attention, because what's happening in these markets today is not what they're telling you it is. There is a game being played, and if you don't understand the rules, you're going to get played right along with it. So sit tight, because we're about to break this whole thing down. First, let's talk about something that's quietly shifting in the background that almost nobody is connecting the dots on. We've got a new Federal Reserve Chairman, Kevin Warsh, now sitting in that top seat. And yeah, Jerome Powell is still floating around somewhere in the background, still on the Board of Governors, still hovering over everything like a ghost that won't leave. But here's the thing, even Powell can't stop what's coming. Because Warsh didn't get that job by accident. Donald Trump did not hand that position to just anybody. Kevin Warsh is as loyal to Trump's economic vision as it gets. And everybody who's been paying attention already knows what Trump has been pushing for since day one: lower interest rates. So when I tell you we are getting a rate cut before this year is over, understand that's not a random guess. That's reading the room. Now, is that my personal opinion? Absolutely. You go do your own research and form your own conclusion. But everything I'm seeing points in that direction. Now here's where it gets interesting, and a little frustrating, honestly. This morning, right around 8:30 a.m. Eastern Time, a report dropped on housing starts for May 2026. And the moment that report hit the wire, you could watch the futures react in real time. The Dow stayed green, but the Nasdaq and the S&P futures flipped red almost instantly, just like that. And the headlines started rolling in. US housing starts fell sharply in May. Home building activity declined. Came in way below economist expectations. Sounds alarming, right? That's exactly what they want you to think. Here's what they conveniently leave out of that headline. We have been below expectations on new home starts month after month, year after year since 2023. This is not breaking news. This is not some sudden economic catastrophe. This is the same story with a fresh date stamped on it. The Commerce Department report showed housing starts fell 15.4% in May to about 1.177 million units. Economists had expected 1.43 million, and starts were down 8.7% compared to May of last year. Residential building permits were also slightly below expectations. The National Association of Home Builders put out data showing builder confidence continuing to slide because of affordability pressures. None of this is a surprise to anyone who's been watching this space for the last few years. So the real question isn't, why did housing starts fall? The real question is, why would they ever go up right now? Think about it logically for a second. The 30-year fixed mortgage rate is sitting between 6.44 and 6.57% as we speak. Do you know what that does to monthly payments? Do you know what that does to a family trying to buy a first home? And then on top of that, the cost of lumber, concrete, drywall, rebar, labour, all of it has gone through the roof over the past few years. So you've got sky-high material costs stacked on top of sky-high borrowing costs for both the builder and the buyer. And yet somehow the expectation is that new home construction should be booming? Come on. That's not how math works. That's not how any of this works. We are roughly 4 million housing units short in this country right now. Not because builders don't want to build, not because there's no demand, because the economics of building and buying at these rates simply don't pencil out for most Americans. This isn't a mystery, this isn't complicated, and it certainly isn't a reason to panic about the stock market. But that's exactly how they're packaging it, because sensational headlines serve a specific purpose, and that purpose has nothing to do with informing you. Here's what's actually going on behind the curtain. When the market rips hard, like it did on Monday the 15th, the short sellers, the people who are actively betting against stocks, they're sitting there watching their positions bleed. So what do they need? They need a catalyst. They need something, anything, to turn the tide and push prices back down so they can cover their shorts at a better level or reload their positions. And what better way to do that than to take a housing report that's been weak for 3 straight years and blast it across every financial media outlet as if it's the signal of an impending collapse. It's not a coincidence. It's a play. And if you don't see it for what it is, you'll react emotionally, sell into the dip, and hand your shares right over to the people who manufactured that fear in the first place. I told you guys last night to be ready for this. When you get a big green day like Monday, the next morning is almost always choppy. I laid out the bull case, the bear case, and the alternate scenario. The bull case was everything continuing to hold up. No major negative surprises, oil prices staying soft, treasury yields staying contained. And look at what's actually happening on that front right now, because this is the part the headlines are not screaming about. Brent crude oil futures dropped 4% and fell below $80 a barrel for the first time since March. WTI crude is sitting under $77. That is massive. Because here's the thing about oil prices. When energy costs come down, inflation follows. It doesn't happen overnight, but the relationship is direct. We saw in the May CPI report that nearly 60% of the jump in headline inflation came from rising energy costs. Pull that out and go to core inflation, and we actually came in better than expected. So falling oil prices are not just a headline number. They're the key to unlocking lower inflation readings in the months ahead. And Treasury yields? The 10-year is sitting below 4.5%. The 30-year is below 5%. Those are numbers that matter enormously for the stock market, because when yields come down, the discount rate on future earnings comes down and stock valuations expand. The bond market is essentially telling you that investors see lower rates on the horizon. That's bullish, not bearish. On top of all that, the 60-day ceasefire between the US and Iran is still holding, and word is that a more formal peace arrangement is expected to be signed by the end of the week. Think about what that does for global oil supply and geopolitical risk premiums. Every barrel of tension that comes out of that region is another support beam under the idea that energy prices can stay contained. And lower energy prices, as we just talked about, feed directly into lower inflation. Now, Wednesday is the day everyone should have circled on their calendar. At 2 p.m. Eastern, the Federal Reserve is going to announce their rate decision, and the near universal expectation is that they hold rates steady. That's not the news. The news is what happens at 2:30 p.m. when Chairman Warsh steps up to the microphone. Because the tone of what he says, whether he leans hawkish or dovish on the path forward for interest rates, that's what the market is going to respond to. And I believe, based on everything I've observed about who this man is and why he's sitting in that chair, that he is going to strike a dovish tone. He's going to signal openness to cuts. And if that happens, everything that dipped this morning on the housing starts news bounces right back and then some. Look, I know this can be a lot to process in real time, especially when you're watching red numbers on your screen and the financial media is throwing apocalyptic housing statistics at you before the market even opens. But you have to train yourself to zoom out. You have to ask, is this genuinely new information that changes the fundamental outlook, or is this recycled noise being weaponized to move prices in a direction that benefits the people doing the yelling? 9 times out of 10, it's the latter. And the housing starts report today is textbook. The fix for the housing market is not complicated at all. Lower the 30-year mortgage rate to 5%, to 4.5%, even to 5.5%, and watch what happens to new home starts almost overnight. Builders will build because buyers will buy. It's that simple. The demand is there. 4 million units worth of demand is sitting right there waiting. The only thing standing between that demand and construction activity is the cost of financing. So until we're having a real conversation about bringing mortgage rates down meaningfully, these monthly housing reports are going to keep reading the same way. And that should not be your signal to panic out of the stock market. Here's the bigger picture you need to hold on to. SpaceX just went public last week and popped another 9% today, trading around $201 before the bell, after pricing its IPO at $135. Goldman Sachs and Caterpillar are holding up and pushing the Dow into positive territory, even while the Nasdaq and S&P are navigating the morning chop. The structural supports for this market, falling energy prices, declining treasury yields, a Fed that appears to be moving toward a more accommodative posture, and ongoing progress on geopolitical risk, those supports are still in place. The whole point of the stock market, at its core, is to go higher over time. That's not blind optimism. That's what the historical record shows over and over again. And what the historical record also shows is that the people who get shaken out by manufactured volatility, by carefully timed negative headlines designed to create fear and doubt, are the same people who miss the recovery. Don't be that person. When they hand you a dip on news that's been known for 3 years, you look at it as a gift, not a warning. You take the dip. You stay in position. You let the noise be noise. At the end of the day, they can run these housing start headlines every month for the rest of the year. It won't change the trajectory if oil keeps dropping, yields stay contained, and the Fed signals rate relief is coming. Stay focused, stay logical, and don't let the manipulation machine pull you off your game. We've seen this movie before. We know how it ends. And it doesn't end with the market in the trash. It ends with patient, disciplined investors sitting on gains, while everyone who panicked is left trying to figure out where they went wrong. Just be patient, keep executing, and let the market do what it always does: go higher.